Welcome to our 2024 mid-year market outlook. Let me start with a brief recap of the markets in the first half of 2024. The economic momentum from Q1 continued into Q2, resulting in another positive period for the global markets. On the equities side, the markets continued their surge higher. S&P 500 was up more than 15% on a year-to-date basis, its best start in an election year on record. Companies exposed to AI continued to outperform, with mega-cap tech names leading the charge, backed by a strong earnings momentum. As a result, the tech-heavy Nasdaq index continued its dominance, jumping close to 20% in the first half of this year. In contrast, the bond market returns were much more subdued. US Treasury yields traded with a narrow range as investors oscillated between different rate cut expectations. Looking ahead, as we transition into the second half of 2024, the confluence of easing monetary policies and the upcoming US elections could create an inflection point for the US economy. Let us first look at the US monetary policy data. The headline inflation in June dropped to 3%, its lowest level in 3 years, while core PCE index, Fed's preferred inflation measure, was 2.6% in May, getting closer to Fed's target of 2%. Also, Fed Chair Jerome Powell in a first signaled a policy shift that the Fed may consider cutting interest rates much before reaching its 2% inflation target as a response to the cooling job market and the slowing economy. Market expectations have thus shifted swiftly to 2 rate cuts this year, one in September and another one in December. So what are the key implications of the impending interest rate cuts? Historically, after the first rate cut, value stocks typically outshine growth stocks for the initial 6 months. Investors also tend to shift focus to undervalued stocks, viewing them as potential bargains. Similarly, small cap stocks often catch up and outperform large caps within 12 months due to their ability to capitalize on lower interest rates. On the other hand, bonds have consistently outperformed equities during the 3, 6, and 12 months following the first rate cut. Turning our attention to the upcoming US elections, this could be a pivotal moment for the US market. The recent failed assassination attempt on Trump has significantly increased his chances of re-election. While short-term market volatility is expected, equity markets should remain broadly supported. Sectors such as financials, energy, and defense could be key beneficiaries in case of a Trump win, with the tech sector softening due to a more headline and regulatory risk. Now, let me share our top 3 investment themes for the rest of the year. Number 1, cash presents significant reinvestment risks. Lock in attractive yields with bonds before the rates drop. We believe the era of elevated yield on cash savings is coming to an end. More than $6 trillion is still locked in money market funds. As the Fed starts cutting rates, close to 50% of these funds is expected to be reallocated to investments and dominated by bonds. Bonds still also offer attractive risk-adjusted returns and are expected to outperform cash by at least 3% per annum over the next 3 to 5 years. The time to act is now, as the price action on bonds typically starts taking effect before the actual rate cuts. We recommend investors to lock in the current attractive yields in the bond market before it is too late. Number 2, move beyond the Mag 7 and capitalize on the sector rotations in equity markets. The concentration risk of mega cap stocks within the market cap indices such as S&P 500 has reached unprecedented levels. Despite their collective outperformance, the returns from the Mag 7 stocks, excluding Nvidia, have trailed the S&P 500 on a year-to-date basis. Earnings growth in mega-cap tech stocks is also expected to slow down while picking up in the small and mid-cap space. We are now seeing strong signals of sectoral shifts as rate cuts take hold. We encourage investors to move beyond the Mag 7 stocks and add quality, mid and small cap exposures to diversify and take advantage of the cyclical rotation in the equity markets. Number 3, S-REITs are expected to stage a turnaround. S-REITs have seen lackluster performance over the last 3 years, impacted heavily by record high interest rates and a higher for longer rate expectation. With rate cuts finally on the horizon, a brighter future awaits for S-REITs. After dropping more than 10% this year, bullish sentiments on S-REITs have emerged. S-REITs staged a 5+% rally in just the last 1 week as the probability of a September rate cut edged closer to 100%. S-REITs are also trading an attractive price-to-book valuation of 0.8x, significantly below their 10-year average. With light positioning and appealing valuations, S-REITs can rebound quickly once the rate cuts begin. Currently offering yields above 6%, S-REITs provide compelling value. Early positioning can allow investors to benefit from potential capital appreciation and an attractive yield. Thank you for watching. Stay tuned for more updates and insights.